Hello friends, this is Dr. Amarjit Kaur, Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. This is my privilege that I am here with you this day to talk on net present value technique of capital budgeting, which we will discuss in two parts. So friends, in the past when we started this series of financial management, we talked about three decisions, that there are three important decisions in financial management. Number one, investment decision, number two, financing decision, and number three, dividend decision. So all the three decisions are actually taken considering the fact in mind that the business has an objective to increase shareholders' wealth. So the question comes in, how do we achieve this target, this objective of shareholders' wealth maximization? To achieve this objective, these three financial decisions, investing, financing and dividend, are to be taken care of very well, so that finally the shareholders' wealth is impacted positively, means we are able to increase the shareholders' wealth. So, coming to the first decision, in financial management, the investment decision, which is pertaining to investment in fixed assets, or other way, the investment which is affecting long term decision, which is affecting the long term profitability of a business. That is what is the investment decision, because if we buy a machinery, it's going to serve us for more than 1 year. If we create a new building, it is going to impact the business for 50 years, 100 years. So the investment in long term assets is investment decision, which is the most crucial one, because there is a scarcity of the resources, and also this impacts in the long run to any business for that matter. So investment, when we say investment decision, means modification in current fixed assets, the addition to the existing or the current fixed assets, or disposition of the, if we want to dispose of the existing fixed assets. All those decisions are actually long term capital investment decisions, and there are many techniques to decide about investing in a particular long term asset or not. So all those techniques, they are categorized into two different categories. One are the ones which are known as non discounted or traditional techniques, which has been covered in the past. And today we are going to talk about those techniques which are actually pertaining to the ones where we use the discount rate. So we call them as discounted techniques of capital budgeting. So there are many techniques in capital budgeting which are discounted ones. We call them as modern techniques as well. Out of the techniques which I am going to just show you, we are going to take only the first technique, net present value. That is the agenda for the day. So the modern evaluation technique for capital budgeting decisions are primarily for net present value, profitability index method, internal rate of return method, and terminal value method. So out of the four, the agenda for today is to discuss the net present value in detail. The rest of the three will be taken up in future series, future lectures. So as the name suggests, net present value, it means the present value which is net, the difference, the present value of inflows and present value of outflows. The difference of these two is net, right? So this technique is basically considering cash flows, both inflows and outflows. Their difference is net. So net present value is primarily the difference of discounted cash inflows and discounted cash outflows. So this is the crux, this is the base of net present value. So to define it, net present value method is a capital budgeting technique which is used to determine the profitability of a project or investment by considering time value of money. So it's very important to remember that the time value TVM is the fundamental rule, the golden rule in financial management. So, the time value money is used in this method, unlike the ARR, the accounting rate of return, where we do not use time value money, we just use accounting profits. But in discounting technique, we always use, in all the 4 ones which I just showed you in a minute in the last slide, we use time value of money. So, it's a technique which is to evaluate the profitability of a particular project or investment proposal. So, it is a capital budgeting technique, as I said, and it calculates the difference between the present value of cash inflows and the present value of cash outflows over the life of the project. So, the project's life could be 5 years, 10 years, 20 years, and for a building it could be 50 years. So, how much cash inflow as a business I am going to get over the life, 5, 10, 23, whatever the number of the year of the life is for a project or a building or a machinery, we consider the complete cash inflows over the life, and also we do consider complete value of cash outflows. So, what does it mean? Let us say if I am buying a machinery today for 20 lakhs rupees. So, my immediate cash outlay or cash outflow is 20 lakhs, but after 3 years I may require service, I may require overhauling of some part of the machinery. So, I may need to spend another 4 lakhs after 3 years, after 4 years, or maybe more than once even I need to spend. So, even that outflow which will happen in future, right, it is not happening today. Today you are spending only 20 lakhs, but you are going to spend another 3 lakhs, 4 lakhs, 5 lakhs, 10 lakhs, whatever, or on the service of or replacing of any part. For example, a car, if we drive car, so there are certain parts, the gearbox, the clutch plate, that or even the tires, they needed to be changed after some time, right, basis on the uses of the car, of course. But they do not, these 3 items which I just mentioned and many more such items are there, they do not last over the life of the car. The legal life is 15 years, the actual life could be more than that, 20 years as well. The legal life defined in Delhi NCR is 15 years for a petrol car or even for an EV. So, point I am making is that whatever we spent on car for replacement of gearbox, replacement of clutch, etc., or tires, that or the battery even, they all are additional cost. So, my real cost is not, if I buy a car for 10 lakhs today, my actual cost is not 10 lakhs. Even the expenditure which I have not spending today, I am bound to spend in future, even that is the cost of the car. If I am going to assess the revenue I am going to generate from the car, or the cost I am going to save by not selecting other means of commuting, right. So, it will be cost reduction or the revenue generation, 2 of the things has to happen for the business. So, the point is whatever we are spending today is cash outlay or outflow, whatever we would spend in future as well, that total is to be discounted, and we are going to use the time value money to get today's value of all the cash outflows. And same happens in cash inflows. My revenue, maybe the machinery is going to help generate revenue by producing products for me, by rendering service for my customers. So, whatever the revenue that machine is going to generate, even that is going to be discounted. Why? Because revenue is not happening today at 0 level, right? It is happening in future. Some revenue after 1 year, some revenue after 2 years, and of course, the value of revenue received today is more than what we will get 1 year from now, and the value of 1 year's from now is more than what we will get 5 years from now. So, that is what the time value money concept is all about, right. So, net NPV calculates the difference between these present values of inflows and outflows, the examples we just took to discuss the concept. So, to use this technique of net present value, we have 3 key concepts basis on which this the whole technique of net present value is working. So, those three techniques are time value money, discount rate and cash flows. With the help of discussion, so far, I believe you would have a fair idea how this net present value works. But let me just explain these three concepts to you. The time value of money concept says the logic that money today is worth more than the same amount in future. That is what the time value of money says. Like, let us say if you have 1000 rupees in hand today and you are going, and somebody tells you, give me 1000 today and I will return you 1000 after 1 year. So, it means he is not actually giving you the exact amount what he is borrowing today, he is paying you back less. Let us say somebody took 12 lakhs from me or from you, right. So, the amount which has been returned after 1 year, 2 years, 3 years, it has less value because you lost the opportunity to earn those on those amount on those numbers whichever you have extended to somebody. So, this could be in family, this could be in business. So, same thing is applicable. So, the value of money in today is more than what it will have in future because of the inflation, etc., etc. The second concept, which is discount rate, is basically the rate which is used to discount the future cash flows, both inflows and outflows. We need to bring all the cash flows at comparable level, right, because cash flows, both inflows and outflows, are happening at different time periods. Something as a cash inflow is happening 5 years from now, 7 years from now, 2 years from now. Same way even the spendings are today and in future. So, we need to make them comparable because net present value is the difference of discounted cash inflows and discounted cash outflows, and both are happening at different point of time. So, that is where to discount the cash flows we use a rate, and that rate is basically nothing but the weighted average cost of capital of the funds a business is using, right. So, we are actually adjusting risk and desired rate of return both in the discount rate. So, if the business has a high risk, so they will get funds at a higher rate obviously, right. So, it means their desired rate of return is higher than other business, because if I am paying 18%, let us say if I took loan or overdraft facility from a bank or any institution, right, at let us say 14%. So, my desired rate becomes minimum 14% or more than that. If I am earning less than that, I am not creating value for the business. So, I must earn something more than what I am paying as a cost of funds, right. So that becomes that 14%, the rate at which your average funds cost is, that becomes the discount rate. So, the discount factor is chosen from the table or is selected from the table basis on this rate. So, that is the second concept behind NPV, and the last is the present value. So, basis on the discount value and time value of money, we calculate present value of future streams of cash flows, and that is the value which is actually considered for projects to decide either to accept a project or not. So, these are the three key concepts of NPV. Question comes in that how do we choose discount rate? I just mentioned that cash flows are discounted. So, the cash flows are actually discounted basis on the average rate of return a firm must pay to its long term creditors and stakeholders for the use of their funds, because company is using funds which are invested by shareholders, which is equity, or it is using debt. Debt could be OD, that could be debentures, that could be bonds, etc., etc., or any bank loan or any term loan. So, these are the long term creditors who have given you some money, right, and the equity holders have given you money for the life of the business. So, so the average cost of these two, debt and equity funds, is known as or is taken as cost of capital, which we also call as WACC, weighted average cost of capital. So that is how we choose the discount rate. And companies mostly the company's cost of capital is usually regarded as the minimum required rate of return or as discount rate. Now question comes in, how do we actually calculate net present value? So there are two different possibilities. One, that the cash flows are happening only once, like we are paying once or we are receiving only once, and second option could be that we are paying for more than once, we are receiving more than once. So NPV in two different situations, the concept remains same, that net present value is the difference between net present value of cash inflows and net present value of cash outflows. So have a look at the formula. The cash flows divided by 1 plus I raised to power t minus initial investment. So initial investment is what? The present value of cash outflow, and cash inflows which are discounted divided by 1 plus I raised to power t is basically what we are getting. This is when we are just receiving cash flows once. But if we are receiving cash flows more than once, then what happens? We will simply make a summation. In that case, the formula goes like this, which is there on the screen. The NPV is equal to summation the sigma or summation cash flows, right, or for the ith year t, right, divided by 1 plus discount rate raised to power t. So here the cash flows for a particular year, the t here is the time period, and then the discount rate for that particular period, and we will subtract initial investment. So ultimately we are talking about net present value of cash inflows and net present value of cash outflows only. So in this formula, summation, the sign, the sigma sign, it represents the summation of all cash flows. The cash flows underneath the T is the net cash flows in period T. Discount rate is the chosen discount rate, which is working weighted average cost of capital. T is the time period. Initial investment is the upfront cost of the project. Whatever we are paying today is my initial investment, right. This is the formula. All the symbols used in formula have been explained. Now, what are the typical cash inflows for any business? Typically, there are many cash inflows happening during a project. Let us say the first of and the foremost thing is, whatever the working capital being invested for that particular project, it gets released at the end of the project or in the terminal year. So salvage value is the second thing, reduction of cost is the third, and incremental revenues are the fourth, is the fourth inflow. So let me explain all of these 4 points to you. So release of working capital, as I was saying, if a new project is undertaken, we generally end up requiring additional working capital. When I say working capital, means the net working capital, which is current assets minus current liabilities. So what are current assets? I may need more cash, I may need more bank balance, I may need more stock, I may raise more debtors because I am just so debtors are the another current assets, and so on. And then the current liabilities are like, for example, the creditors goes up, bills payables goes up, prepaid expenses which has been not paid, due which are due are another liabilities. So the difference of current assets and current liabilities, working capital. So for most of the projects, generally it is expected, it's not mandatory, it's not compulsory that it will happen always. Most of the time the working capital requirement goes up. So when working capital goes up, the more people were employed, salaries were paid, etc., etc. But when the project gets into the terminal year or is completed, all that working capital gets released, maybe not exactly the same amount, lesser than what we invested, but we do get release of working capital. So, that is the cash inflow out of that project. The salvage value of the machinery, if we sell it, if we know after the useful life of the car, even we we may sell it to anybody for metal, etc. Same is for equipments, machinery, plant, etc. Even the useful life is over, we are able to sell it. That is what is residual value or salvage value. So, this is another cash inflow. The another important, the real cash inflow could be the cost which gets reduced. Let us say I was spending on electricity bill in the past when I was using an old machine, let us say 1 lakh a month. Now, after investing into the new machine, I am going to pay only 30,000. So, there is a saving of 70,000. This cost saving is also taken as cash inflow, because investment decisions are always taken either to save the cost or to increase the revenue. So, the fourth point is incremental revenue. So, incremental revenue means earlier I was earning a revenue of 20,000, now I started earning 40,000, 50,000, 60,000. The difference between the two, what I was earning earlier and now, is my incremental revenue. So, saving of cost, increased revenue, salvage value recovery, working capital recovery. These are the four major heads of cash inflows. Same way we have cash outflows as well. The four cash outflows are repair and maintenance, initial investment, incremental operating cost and working capital. So, outflow, as I said, working capital we just discussed. When we started the new project machinery, we needed more people to work, we needed more cash, bank balance, more debtors, etc. That was requirement of working capital. So, that is the outflow in the beginning. Then we may need to spend on repair and maintenance during the life of the project, that is also another outflow. Whatever we pay initially is certainly an outflow, right, that is an outflow or outlay. And then any operating cost which goes up, which is taken as incremental operating cost, is also a cash outflow. So, these are the outflows and inflows. Now, what we do, we compare inflows and outflows after discounting them, and then we decide either to accept or reject a proposal. So, what is the accept reject criteria? Here are the three different situations. If NPV is positive, means my cash inflows are more than my cash outflow. So, that is a positive situation. So, we call it as acceptable, since it promises to generate more revenue for the business greater than what it is actually earning now. So, positive NPV is always a situation to accept. So, when NPV is 0, means my cash inflows are equivalent to cash outflow, we are, so this calculation does not give us an idea to accept or not. Then the other factors needed to be taken care. The other, it could be any other logical decision or it could be emotional one, but this 0 value of NPV suggests you that it is up to you. Consider other factors than NPV to reject or accept. It means it is a neutral situation, it is an indifferent situation. Here, if a business gets into the situation of 0, then business has to see, is there an obligation by the government of India, by any other state government, or is there any future benefit of investing today in this project. This project may sound indifferent, 0 NPV, but it is going to help you build relation with someone, etc., etc. The other factors becomes more important in that situation. And when there is a negative NPV, means my cash inflows are less than my cash outflows, like, so it is a negative situation. In that case, as per NPV, if we are using NPV, it is suggested to reject the proposal, means not to implement that project or proposal. So, this whole concept of NPV is based on two major assumptions. Those assumptions are that all cash inflows other than the initial investment, they occur at the end of period, right, end of year 1, year 2, year 3. So, end of year. and all the cash flows which are generated by the investment projects, they are immediately reinvested at a rate of return equal to the discount rate. So, these are the two important assumptions basis on the which this capital budgeting technique of NPV is based, and these are the two important assumptions to understand this NPV very well. So, friends, in this session we discussed what NPV technique is. It is a discounted technique known as modern technique. We discussed about how to calculate NPV in two different situations. We talked about the sources of revenue or sources of inflows and sources of outflows of cash, and also we talked about assumptions of NPV technique. With this, I would like to now wind up. Thank you very much.